Ye Diwali, Muskan Wali. And my guest on the show is someone who always has got a smile on everyone's face every time we've asked him a simple question. What is your view on India? I've had the pleasure of interacting with Chris Wood now for nearly 2 decades. And there is one thing which is constant, which is a smile on his face and his bullish outlook on India. I can easily say in last 20 years, he's right at the top in terms of his assessment of the economy and perhaps ahead of everyone else when it comes to predicting the trends. But in bullishness on India has been consistent irrespective of the economic cycle, valuations or the global environment. Chris, first on behalf of everyone from ET Now and our viewers, this is festival time, so a very happy Diwali, season's greetings.
Thank you.
Well, we're calling this Diwali on ET Now Muskan Wali, which is this Diwali, may God bless you with smile. And I must say that every time I've interacted with you, our conversation has been full of smile because you've always said very nice things about India.
Yeah. I'm glad to hear that. It's not the same with every country.
So Chris, we can argue about the global market right now, positioning of interest rates and which way Fed is going to move. But bottom line here is that unlike what everyone thought at the beginning of the year in terms of a global slowdown, impact of rate tightening or the impact of Ukraine or Russia war, that really has not been the problem point for 2023. Are you a bit surprised with the resilience?
No, I am surprised at the resilience of Wall Street correlated world stock markets because we've had the biggest monetary tightening cycle since late 1970s. And we've had actually in the last quarter a big rise in US Treasury bond yields. So the resilience of the US stock market is surprising, but it's also worth noting that the S&P is a bit misleading. If I showed you a chart of the Russell 2000, in fact I showed this chart in my latest screen here, the Russell Small Cap Index, or I showed you a chart of the US Bank Stock Index, actually these charts look much more like they're worrying about a US recession. Whereas the S&P 500 is really dominated by what has become what people are now calling the Magnificent Seven. And these are these big giant tech stocks. And there's three key things to understand about these big tech stocks. First of all, they're not US economy plays, they're global plays. So more than 50% of the revenues of these big seven companies are derived from outside the US. Second point, they are free cash flow positive and they have big cash balances, which they're earning 5% on. And third point, since Microsoft's acquisition of GB Chat at the end of January this year, they're now viewed as potential AI plays.
So do you think the surge in US financial markets will not sustain and the impact of high interest rates and monetary tightening will be felt with a lag effect?
Well, I think on the US economy, yes. But I think we already see the impact of monetary tightening in some of the other areas of the US stock market because the market's actually much less buoyant if you take out those seven stocks. But obviously the headline perception is driven by the S&P. But yes, on the US economy, my own personal view is we have not seen the full impact of monetary tightening. And in my view, the base case is that impact of monetary tightening will become more evident in coming quarters. Because the thing is, we had a huge explosion in M2 growth in 2020 in response to the pandemic. That's what caused the surge in inflation. As a result of Fed tightening, we are now seeing an unprecedented collapse in M2 growth, which has negative implications for the economy and asset prices in the US. But there's a huge base effect from the previous explosion. So actually, in terms of what I've been tracking, the M2 to nominal GDP ratio, we're only just back at the pre-COVID trend. We haven't yet gone below trend. So it's a bit like a rope around someone's neck. It's just gradually, the pressure is just going to start being applied more. So I would expect more, in the world where the Fed doesn't start easing, I would expect more of an impact in coming quarters. If there's no recession this time next year, then I will admit the US has achieved a soft landing. But basically, I think it's premature to draw such a conclusion.
So you are of the view that there could be a recession in US economy in next 12 months.
Yeah, the surprise will be if there isn't one, because all the classic macro indicators are flashing warning signals. We've had an inverted yield curve. Bank loan growth is now turned down. So commercial and industrial loan growth this time last year was 15% year on year in America. Right now it's 0. So, but there's one area where the credit's still flowing in America, which is not captured by the banking statistics. This is in private credit. So that area is still extending credit and keeping the cycle going.
If US slips into a recession, and since that's the world's largest economy, it will have far-reaching impacts, and especially far-reaching impacts on financial markets, and risk in the world could be redefined. So are we in for repricing of risk? Are we in for repricing of financial equity markets in general? Because if world contracts, equity, which is a growth denominated asset, will contract the fastest. That's
true, but there's one silver lining of any recognition that US could be entering recession, and that will be a very sudden U-turn by the Fed.
And you see that happening? How soon do you think Fed will cut rates?
Well, no, the question is, does the data weaken? So long as the labor market's holding up, the Fed will keep policy on hold. My guess for the last few months is we've seen our last rate hike. But the issue is what happens if we suddenly get more weakening in the US labor market. In my view, in a world where the Fed is put in a position where it has to prioritize the employment mandate, or its inflation mandate, my guess is they prioritize the employment mandate, even if inflation is not yet at 2%. And in that world, that will send a signal that the Fed's not going to fully enforce its 2% inflation target. And that will send a signal that will be negative for the dollar, which will be good for emerging markets, but it will be negative for the US government bond market.
Chris, the positioning of India, both in terms of absolute and relative, I guess is best in the world. It's the strongest I've seen in a long, long time. Yet if I look at the FI positioning, FIs have been selling into Indian market on every rally. The technicals in the F&O market are also indicating that FIs are more short than long. So at a time when India should be getting more inflows from global investors, looking at the big picture you sketched for us, the liquidity is actually the other way around.
Yeah, no, the foreigners, we believe global emerging market funds are only about 1 or 2 percentage points overweight India, which given India's got, in my view, too low a benchmark weighting in the emerging market index, given the the strength of the Indian story, I think that's very, that is not overweight at all. That's very, foreigners could be a lot more overweight India. So any pullback in Indian equities, in my view, will be bought by foreign investors. Meanwhile, that's dedicated global emerging market funds, but there's a whole category of global equity funds who historically have not invested in India. It's now become consensus that the new long-term growth story in Asia is India, not China. But while this is the consensus, global equity funds are not positioned for that. So there's a huge potential in the next 5 years for global equity funds to start investing in India.
So do you see gradually, slowly, but surely, money will move out of China, move back to India? It could happen in 3-5 years?
Well, no, the global money is not investing in China.
Okay, it's not going there.
They stopped instead investing in China.
But do you see it coming out from China, going back to India?
When they said the dedicated emerging market money will stay in both China and India. But the global money was investing in China. In many cases, they've stopped investing in China for geopolitical reasons as much as anything else. And they haven't yet started investing in India. This year, global money that stopped investing in China actually probably went to Japan. But the problem is, if you're a global fund and you want to invest in India, if you're not set up to invest directly in India by FII, then you've got very limited options offshore because there's not many Indian stocks trading in New York.
Chris, Indian markets are trading at a premium, and the reason why we are trading at a premium is largely because of stability, political stability, a stable tax regime, a country where you can invest, and if you want to withdraw, you can withdraw. If there is a change of guard or change of administration in the next election cycle, May 2024, do you think that could open significant downside in the short term?
No, yeah, I think the base case has to be a sharp correction if the government's not re-elected. I think the parallel is 2004, which was a big surprise when it happened. This is a market with a lot of domestic money in, and I think that would be a big shock to the market. But I do believe the foreigners would buy on such a sharp decline.
What could be the extent of collateral damage if we have a change of government?
Well, an outright change of government like what happened in 2004, total 100% surprise, I would say 25%, which is about decline, which is about what it was, I believe, in 2004 from memory.
So we pretty much would see that kind of a shock wave which may last for next couple of months.
But I don't think it would be a long-lasting, I think there would be a sharp rebound with a lag.
Why do you say that?
Simply because I think the foreign money will come in. And there'll be there will be an immediate shock, but then there'll be a realization that a lot of the changes made have staying power. But it would also happen at a time when India's economy's got a certain momentum. One key point is we're now entering our third year of a residential property upturn, which gives a fundamental momentum to the economy. That means property prices are rising. It means that the collateral of the banking system's improved. And we've seen this year, manufacturing Capex geared stocks do well, which is sort of signaling that the hopes are growing for more of a broader investment cycle.
Chris, I distinctly remember 20 years ago, or maybe 15 years ago, you had a research report which said the following, that looking at the size of the economy and looking at the market cap of real estate stocks in India, there is a mismatch. The size of the economy has become big, and real estate stocks in terms of market cap representation is low. And then we saw multi-year boom in real estate stocks. Could we see a repeat of that cycle?
Well, we're seeing that already. We're witnessing that. So I've got 4 property stocks in my Indian portfolio. We've entered our third year of a property upturn. Now, last year when the RBI was raising rates, the property stocks did very well, I believe, in 2021, when people recognized that the property upturn was starting after, remember, a 7-year downturn. Then we had RBI raising rates, so the property stocks corrected. But although the property stocks corrected last year, the actual property upturn continued. The property upturn was not impacted at all by the monetary tightening. And then in the last few months, as the markets become more hopeful that we've seen the last of RBI rate hikes, the property stocks have rallied again. And it remains the case that, Indian property sector or Indian property stocks are very small relative to the size of the economic opportunity.
So if someone is watching the show and is curious about, should you invest in real estate, which is buy a property, or should you buy real estate stocks? Would you say buy real estate stocks?
I would say you should do both.
Do you see the property cycle or the uptick in real estate cycle could last for next couple of years?
My base case, it can last as long as a downturn, which is 7 years.
Another 4-5 years are still left.
Because we've got a huge pent-up demand precisely because there's a downturn for 7 years. But the other point, we had the most, as brutal a consolidation in the property developer industry as I have seen, frankly, anywhere in the world. I've seen quite a lot of property downturns, but this was a pretty extreme downturn because beyond the normal just cyclical downturn, you had two specific catalysts which created a more brutal consolidation. I would say the first one was demonetization, which you could probably say amounted to a cold turkey for the property sector. And then the second thing, you had this very dramatic regulation or reform of the property market created by the Real Estate Regulation Act, RERA, which has caused a massive consolidation amongst developers. So the surviving developers are in a very strong position because so many of the competitors have disappeared.
Chris, for the longest time, you've had exposure to financials and especially private sector banks. And I can see while ICICI Bank, HDFC Bank are right up there, I want to be specific about HDFC Bank because they've gone through a merger. And markets are worried about the merger going through in terms of the return ratios which could be under pressure. But the merger has not shaken your conviction. While HDFC Bank is part of your portfolio, it is actually half of what its representation in the Nifty is.
Oh, well, I'm not looking at it like that. So I've got a selection, but clearly this particular bank is at a much big, there's been a significant derating relative to history, right?
Yes.
So I think, but in a couple of the major Indian private banks, we have succession issues. So that's always going to create, there's already going to create some near-term issues. But then you have the technicalities of the terms of the merger. But fundamentally, if global money does come into India, let's say, when I say global, non-dedicated emerging market money, I think the first sector global money will invest in India is the major Indian private sector banks, because they are the domestic demand proxies.
AU Financial is part of your portfolio. Haven't seen this name in your portfolio ever. Why have you added AU Small Finance Bank in your portfolio?
Well, that's just a smaller growing, because one still can't have the portfolio everything with long, big established players. But as I say, as we were discussing earlier, I think the biggest challenge in an Indian equity portfolio, if you're running a relatively concentrated portfolio, so my portfolio is relatively concentrated, but it's between 20-25 stocks. The biggest challenge is what not to invest in.
So you think you have more ideas and less space?
No, exactly. I could easily have 40 stocks in my Indian portfolio.
So what do you think you wanted to add, you have not added?
Well, I have nothing in the auto sector right now. I have in the past. That's one obvious example. An area which did very well the last 2 years, which I was sort of familiar with, but I didn't put any money in there, was the defense sector. Then I could definitely have more in the power sector. I could have more in the engineering capital goods sector. And then I have almost nothing in the consumer sector. I have zero in IT services. So there's there's any amount of them.
But in terms of relative outperformance, since it's a tight portfolio, it's available in public domain, we'll put it out. You have a very strong concentration, which is 50%, 56% of your India long-only portfolio is in just 3 sectors.
Yeah. Now, my 3 areas I've been playing right of late is financials, property, and what I would define as Capex related. So if I wanted to focus, but I'm running this quite structurally, less tactically. So structurally, I've always had the private sector banks in my Asian portfolio. This Indian portfolio was only created more recently, but my Asia ex-Japan portfolio, which I run, the Greed and Peer portfolio, which I've run since 2002. Yes. The one sector I always had representation since 2002 is Indian private sector banks.
And how has that portfolio done? What's been the return of that portfolio?
That portfolio has massively outperformed the benchmark, the Asia ex-Japan.
Okay. So
I haven't got the data in front of me.
In that portfolio, apart from private banks, what else do you have?
What? Oh, right now?
Right now?
No, right now I'm about 45% in India.
45% in India. And
Roughly.
That would be a combination of these 3 sectors.
From memory, the dominant, and about 15-18% in China. Then I have some semiconductor plays.
Okay.
But
45% in India.
But if I do an attribution exercise on the Greed and Peer Asia ex-Japan portfolio since 2002, the dominant where the alphas come from would have been predominantly in India.
We met in May last when you were in India, and that time you added Zomato to your portfolio. Now, while the classification is internet, I think it's becoming a consumer company.
Yeah, that's wrong. It should be defined as consumer.
Do you think a company like Zomato has a long way to go? Because even the run-up in Zomato has gone from 50 rupees to 100 rupees, the market cap actually still way below $20 billion.
Well, the interesting thing about when I last checked this, the Zomato market cap is way lower than the nearest equivalent in China, which is Meituan.
So do you think it could become as big as
Meituan? The key issue, if these stocks actually start making money, then they become very attractive.
For the longest time, you've argued, Chris, that India has one problem, which is that the Capex cycle was not in full bloom.
Well, since 2009-10, yes, we've been waiting for a new one.
But now it has started. Now
we're hoping it started.
Are you convinced that it has started, or you are waiting for some more data?
I'm kind of 80% convinced it started.
The fact that you've got L&T, you've got Thermax in your portfolio, is that an indication that you want to bet on the Capex cycle?
Yes, I mean, there's a case I should have more of these stocks in the portfolio. Well, in the short term, in the short term, these stocks are performing better than the private sector banks. So actually, the best indication that there could be a Capex cycle could be beginning of greater scale than what we've currently seen is the performance of the Capex geared stocks.
You've raised concerns about the unsecured loans in India, and for the first time I've seen you coming up with what could be called as a red line.
Well, the RBI warned about that at its last policy meeting, so clearly this is a bit of an issue. I think the RBI is quite right to warn about it, but it doesn't appear systemic, but clearly it's an issue, and it partly just reflects two things. One, I believe that younger Indians are more willing to borrow than their parents, and which is wholly understandable. And second, it reflects the fact that the digital technology, by providing the sort of pipes, makes it easier to access or distribute smaller loans.
Chris, you can see a lot of visibility in Indian banks right now. Credit is strong, NPAs are low, unsecured loan is growing. So far, there are no early harbingers of any kind of a systemic problem. Yet financials are underperforming. Is that largely because of FI selling?
Yeah, that part, I think, being here this week, I've talked to various people across the financial sector, particularly the fund managers. This is an area people are wondering about. Most people think it's basically down to these areas being overowned and some foreign selling, but I think this is definitely a point of discussion.
What was that one big suggestion or advice you gave to fund managers when you met them in the last couple of days? What was your advice to them?
The domestic fund managers here really want to know about they want a view on what's happening in the US.
And your view is that US could head into a recession?
Well, my view,
surprised.
yeah, my view is obviously many economists began this year forecasting a US recession. In the case of Jefferies, a recession wasn't really forecast to start kicking until the second half of this year. So actually, I never believed the recession would come that quickly. But I have to admit it's been extremely resilient, the US economy. But as I say, if you look at the chart of my M2 to nominal GDP ratio, it explains, which I put in the greed and fear, it shows the lagged effect, because you see this M2 explosion in 2020, that's the top down. But what did that mean bottom up? That meant that the Fed money printing indirectly financed all these handouts, or to use an economist term, transfer payments.
Yes.
To use a layman's terms, handouts. So people were paid money to do nothing. This did not happen in India or China. So this translated for ordinary people to money in their bank accounts, or what the economists call excess savings. And a question which is hard to answer is how much of the excess savings been spent. It looked at the start of this year like 50-60% of them had been spent, but this is not a precise science. So this money is gradually being spent. Meanwhile, there's one whole area where the credit extension continues, which is in this private credit, private equity area, which is not captured in the regular banking statistics. So I think this private credit area is keeping the game going for longer, but in terms of the credit extension game. But in my view, that will mean, what does that mean? That means that more bad loans will be made at the peak of the cycle, which means that the cycle will last longer, but which means that the downturn, when it comes, will be greater.
Chris, so your famous newsletter, Greed and Fear, which is like the go-to newsletter we always read every time it hits our mailbox. So if you have to use the tagline of your newsletter, Greed and Fear, to your mind, which asset class, if you can cut across all asset class, there is greed built in, which asset class has fear built in?
No, the greed is most built in right now. It would be private credit. Okay. That's where there's the maximum greed. I think the maximum fear right now is probably in China. So China's on about 9 times earnings. And while China's got a lot of problems, I personally don't believe the Chinese situation is quite as extremely negative as what you've been reading about in the Western media in the first
Do you
half of
expect China to come back then?
What, the
Do you
stock
expect
market?
Chinese stock markets to come back?
I think if the Chinese property market stabilizes here, it's bottom from the moment. So
And you think flows will come to India irrespective of what happens to China?
definitely. No, China's in a lower growth trajectory for the next, China's growth next 10 years, 3-4%, maybe 4's at the upside, I would say. Whereas India's growth is 6-7% or potentially higher.
Chris, when you meet fund managers, every fund manager has a different risk and a different time horizon. And sometimes you really have to tailor-made your advice based on risk and time horizon. So allow me to do that. I'll phrase my next question differently. So if you have to identify a short-term trade for our viewers, when I say short-term trade, 3 to 6 months, which one would that be? A medium-term investment, 1 to 3 years, and a long-term investment, let's put a number there, 3 year plus.
Sorry,
Three buckets.
What's the first?
First is short-term, less than 6 months.
So in less than 6 months, people should look to buy gold and Bitcoin. For the very simple reason, I would expect adjustment. And based on my view, the monetary tightening impact is going to kick in on the next 2 quarters. You should buy gold and Bitcoin because it will respond to any change in Fed policy. But if you're a millennial, you won't want to buy gold, so you should buy Bitcoin because there's a halving of Bitcoin. Can Indian people trade Bitcoin?
You can buy Bitcoin.
Yeah, so basically the halving of Bitcoin's coming up next year.
Yes.
And I believe it's not a precise timetable, about April, May.
The volatility will come down.
But the precedent is you make money if you buy ahead of the halving.
Okay.
So in the 3 to 6 month period, I would say, gold mining stocks and Bitcoin. And then on the
1, 2, 3.
on the other 2 environments, I'd buy Indian equities.
So for the medium term, which is 1 year plus, and for the really long term, which is 5 year plus, you would buy Indian stocks.
Yes.
Okay. And would you be again advocating that anybody who's got a long term time horizon, which is 5 year plus, the focus should be, according to your portfolio, real estate? It should be largely Capex driven, and it should be financials. 3 sectors should.
But that
portfolio.
can change.
But as of now, that's your view.
As of now, that's my view. But my key point is, yes, any correction from external sources in India should be bought, and even a domestically driven correction, which the only real plausible driver of a sharp Indian domestic correction to me would be relate to the election, and even that is an opportunity to double your exposure.
Couple of last follow-up questions, Chris. Okay, so India is where you want to be in, but let's talk about how much of the good news or the template what we've discussed is in the price, because that also becomes an important indicator for investors. So the last 5 year returns for Indian stocks versus next 5 year returns. Do you think the future return of next 5 years would be higher than last 5 years?
Well, it's not like the returns have been dramatically high.
They've not been very high.
No, so I think, yes, they can be that. So obviously, if you look just at the mid-caps, the returns have been better, but the valuations are much more elevated in the mid-cap area than they are in the blue chip area.
You did raise a concern about Indian mid-caps trading at rich valuations a couple of weeks ago.
Yeah.
After that, a correction has kicked in.
Yeah.
Has that correction come and gone for mid-cap stocks, or are they still looking frothy?
No, I think there's potential. We've had this Middle East events in the interim. So right now the markets have been rallying again, but I think part of the rally we've seen of late doesn't relate just to US GDP data. It relates to the fact that I think markets for a moment there were genuinely concerned, understandably, that could be material escalation in the Middle East of events going on there. And so right now, I think markets are assuming there won't be escalation. When I say escalation, I mean other countries getting involved.
Do you see that happening? Is that a real risk for next couple of months?
It's a risk, but my base case is the same as the markets, that there won't be.
There won't be.
But obviously, if the markets are wrong, then that will cause, and we've seen oil correct $10, I believe, this week.
Yes, 96 has become 86.
Yeah, but well, that reflects that view. The view is that there isn't going to be a broader involvement of other Middle East countries.
So Chris Wood, you've said that the problem for you is that you can have select few stocks in your portfolio, and your portfolio right now, if I count the numbers,
Yeah, how is it? How many is it?
it's actually not even, it's not even 20. You've lost less than 20 stocks in your
So I
portfolio.
think maybe I have to increase the numbers a bit.
But I have a reverse question.
Oh.
If I put a gun to your head, sir, and if I say, Chris Wood, you're only allowed to buy 3 stocks, only 3 stocks,
I have to think about that one.
but would that be only financials?
For what period? For what period?
Let's say 3 years plus.
On a 3-year period, it would have to be the financials.
3 year plus, would you buy just financial stocks and say, okay, I have a concentrated portfolio, I'm happy with it?
Well, I can't sell in that 3 years.
Okay. What about next 1 year?
The next 1 year, I'm sticking with my current portfolio.
And 5 year plus, would you buy property stocks?
On a 1 year, 3, I'll just have one from. I'd have one stock from each area. You know, Capex, property, financials.
Okay.
But on a 5 year, I'd just have financials.
So Chris, you've been coming to India for almost 2 decades now, and when you look at India, what has delightfully surprised you about India? What has surprised you, and what has disappointed you about India?
Now, what's been very dramatic, I would say, is the development of the financial markets here, the capital markets, the asset management industry, and all the variations of it. I think that's been very, very dynamic.
So when Chris Wood is not traveling, and when he's not writing his reports, what keeps him busy?
Well, but I have to write the report weekly.
Which is one Indian dish, and it's Diwali, it's food time, festivities, good food. What's your favorite Indian food?
Oh, favorite food in food, Rogan Josh.
What about
And
Indian sweets?
I don't eat sweets.
But it's Diwali time, and I must say that our conversation has been rather sweet. You always bring this big smile on our face every time we interact with you, because Chris has always been this big India bull. Over the years I've interacted with him. I've interacted with him at a time when the world has gone through tough times, when Indian economy has gone through tough times, but Chris has always put his hand on the heart and said that I'm an India bull, I was an India bull, I am an India bull, I will remain an India bull, because I outright believe in the power of this country. So thank you for endorsing India on every forum, and thank you for just being ET Now's friend, all throughout the life of ET Now.
Thank you, Nikhil. And happy Diwali.
Thank you very much. So that's Chris Wood, ET Now exclusive, wishing, let's say it again, Happy Diwali once again.
Happy Diwali.